In the last market video, I talked about the stock market, especially companies, those who are yet to be profitable or does not have a real need in our day-to-day lives are going to get affected the most. That is the reason I got out of many of the companies that once were a golden child for me. In this video, I'll show you some hard facts and some graphs which not only is going to show us what to expect in the coming days, but also how to prepare for the what's coming next. As I start this video, I will repeat what I said in my last market video. No one has a clue of what might happen and where we will end up in this market. But what we can try and do is see the history and make educated guesses. So let's start this video by some history. Now here is some good news, because if we go by the stats, then 2022 most likely will end up on a better foot than it started. Our stocks have historically performed well during the periods when the Fed raised interest rate. As a matter of fact, stocks have gone up on an average rate of about 9% during the last 12 Fed rate hike cycles since 1950s. But not only that, stock market has delivered positive returns in 11 of those instances. The one exception was during 1972 and 74 period, which coincided with the 1973 and 75 recession. Take a look at the chart and make sense of it right here. So these are how the S&P 500 perform in Fed rate hike cycles right here. And you can see starting from 1954 to 57, all the way coming to 2015 and 2018. And we can see S&P has performed well every year, except one year, which was 1972 to 74, when the recession was going on around 1973 and 75. So 11 out of the 12 times S&P performed well, an average of about 9%. I'll be really happy if that happens, really. Now, here's the kicker. On average, analysts project that S&P will finish 2022 at 4,982 points. That's 13% above Friday's closing level, according to the data compiled by Bloomberg. And just as a context, the index surged nearly 27% in 2021. Its third straight year of double-digit returns. Given the current market conditions, I'll be happy by even 10%. Now, what I'm sharing next is one of those charts that you need to take a screenshot and refer back, as it shows how different categories traded 3 months before the rate hike and 3 months after the rate hike. This is really interesting. So historically, it makes sense for investors to maintain a cyclical bias leading up to the first rate increase. But the performance in the 3 months following that has struggled. There have been 4 distinct periods of rate hike cycles by the Fed in the past 3 decades, and let's take a look what has happened. So this is right here liftoff, how S&P performed 3 months before and after the first Fed rate hike. And these are all the industries divided, and you can see on the orange is basically average performance 3 months before, and gray is average performance 3 months after. So as you can see, 3 months before, materials were doing really good. But as soon as Fed announced the rate hike right here, materials kind of went back or went into negative. So all those who are in materials, pay attention to this data right here. Then industrials, same thing. 3 months before, performed really well. 3 months after, they were negative. Technology, 3 months before, performed well, as you can see right here. And 3 months after, went down. Now here's a change. Now technology is suffering and not doing good. Before the rate hike, already technology is struggling. So can we expect a return of the trend here, where we will see this going down before the rate hike, and then after the rate hike this can go up? Well, just a second, I'll come to that. Energy, as you can see, before the rate hike did well, and after the rate hike did well as well. This is really interesting. S&P 500 before the rate hike 3 months before did positive, and then after went down more. And then communications, as you can see, before the rate hike positive, after the rate hike positive. Utilities, same story. Financials, this is really good, right? 3 months before the rate hike, they were doing okay, around, I would say, 2 to 3% increase in the 3 months before. But then after, they struggled really bad after the rate hike. It should be opposite, but again, average performance 3 months after, they were in negative right here. And then consumer staples, real estate, healthcare. Look at healthcare, nothing 3 months before. They were like kind of sitting dormant. And afterwards, huge negative. So could be some shorting opportunities here. Okay, so this is all really good. Now, as per the data, S&P 500 performance is often strong during the cycle of rate hikes, but the issue is that we have seen very strong 2021. I mean, double-digit gains when half the economy was shut down kind of shows us how bullish market was, and that was the reason why we saw mild pullbacks of about 5% or so, less than that actually, 5% in 2021. And history tells us again that the potential for bigger retreats that sometimes range into double-digit could be in the books. So did you see what happened here? I just contradicted myself because again, the data is so screwed that even history is getting confused. Take a look at the next graph to make sense of it. So right here, see this, S&P 500 drawdowns and returns in year following shallow pullbacks, largest intra-year pullback as you can see, and then the annual return. Pay attention to the theme over here. In 1955, the largest intra-year pullback we can see, it pulled back almost negative 10%. And then after that, it gained almost 30%. That was huge. The same trend followed. In 1962, it was really, really bad, almost close to 30%. And then even the annual was also less. So as you can see, this is old data. We are not too concerned about it. But look what happened in 2018. 2018 was the year when we had that huge crash. And in 2018, you can see in the intra-year, we had a huge pullback close to about 20. And then we also ended the year close to about 5% down. So there have been years when S&P 500 did not do well during the year and also finished the year weaker as well. Will 2022 be like 2018? We don't know, but we have some more data to look at. Another factor we investors need to keep in mind is midterm election in November. Since 1950, the S&P 500 has an average and intra-year pullback of about 17.1% in midterm years. But the final 3 months of the midterm year and the first 2 quarters of the following year, known as the pre-election year, have been some of the strongest quarters for US over the 4-year US presidential cycle. In pre-election years going back to 1950, the benchmark index has an average return of about 32.3%. So everything, of course, is not doom and gloom. And here's a chart to kind of give us some hope right here. So this is midterm election, which is happening in 2022. So that could be our lifesaver. Let's see. So intra-year decline, as you can see in S&P 500, and then returns a year later. And this is all the way data from 1950 going to about 2018. So when they say return a year later, that does not mean like in 2022. That means the last 3 months of 2022 and the first 2 quarters of 2023. Think of it this way. Not that 2022 will finish strong. No, they're talking about the 3 months after the election or during the election, and then the 2 quarters for the following year are very strong or one of the strongest. So 1950, we of course had a intra-year decline, as you can see, all the way close to about 15%. But then the S&P followed year or 1 year after the election. It's finished really, really strong, close to about 36, 37%. Same thing all the way through. And then as you can see in 2018, we had about 20% decline in S&P 500, as you can see intra-year. Then after that, they finished almost 37% positive for the following 1 year. So not the same year, as I said, it's the 2 quarters of the following year as well. So this is really interesting data, and for us to kind of make our plays. Watch out for options in 2023 beginning. And of course, if you're buying it now or in the next few months or so, then there is a huge chance, possibility, again, no one knows, this is the data that suggests that you could be profitable on those options. Again, the data suggests that. I'm not saying anything. I'm not saying buy or sell. So after watching all this data, what do you think I'm saying here? Because when I was doing this research on this topic and I spent some good time on this video, there were so many conflicting information I was reading that I really had to sift through to get to the meat of things. So let's sum it up all together. And this is my opinion only. We are going to see continued pressure in the market for at least next month or 2. Earnings will not matter. Forecast won't matter, and we will see fake rallies all over the place. But those will be short-lived and quickly ended, as more and more will sell and get out as soon as they are breaking even or even reducing their losses. I know I'm ready to do that. Then once we see the inflation numbers come down, things will improve. But for those companies that have real need and have lots of cash in the bank. And then leading up to the midterm is when we will see a rally that could have some legs to sustain for a few weeks. Given that we don't get hit by another variant, very important, because right at that time, we will be entering the winter months and we know what happened in the last 2 years. Again, I could be completely wrong, and I'm saying this because what I'm seeing in the reports and data. No single stock or industry will be able to save us. And as a matter of fact, if a company like Google, Amazon, or Microsoft delivers a bad earning, that will have much wider damage to the sector than if they come out with a positive earning. It's sad, but it's the truth. Let me know in the comments what are your thoughts about the market and how are you planning for the next few months. And if you think I provided some value, then give this video a thumbs up and consider subscribing. As always, a pleasure to share all the info with everyone. Until next time, you all have a sparkling day.